Hi everybody, Alan Ward here from Slow Fortune, and the question I get asked is, should I buy REITs in 2019? Watch and I'll give you the answer. A question I get asked a little bit is, should I buy REITs in 2019? I'll just explain what a REIT is. REIT, Real Estate Investment Trust. It's a way of investing in real estate that can provide you with a lot of diversification for generally a low outlay of capital. So in Australia, think of a REIT almost like a managed fund, where you and other investors pool your money, and that money combined is invested in properties. Now, generally when we say properties, what we mean is commercial, industrial, retail properties. So things like your office buildings, your industrial types, so factories, that sort of stuff, and retail, of course, being shopping centres, that sort of thing. In Australia, up until very recently, the most common REIT that was available was the Westfield Shopping Trust. The Westfield Shopping Trust, as the name might suggest, invested in the Westfield shopping centres around Australia. So that was the trust that actually owned the physical shopping centres and received rent from those shops. I just want to talk a little bit about what a REIT is. So as I said, typically it gives you diversification across properties with generally a low outlay of capital. You might just be able to put $1,000 into a REIT. Generally in Australia, the REITs are listed entities, which means they're like a share. They're on the stock market. You can buy and sell in Australia using the CHESS system. And so if the share price of a REIT is $30, for a $30 outlay, you could buy one share in that REIT. Of course, transaction costs will probably wipe out most of that, so it wouldn't be worth doing for such a small amount. The advantage of REITs is it gives you access across a portfolio of properties. It gives you all the benefits of owning properties and the characteristics of owning properties. So things like capital growth in the property value, which you would hope would happen, and also rent that's being paid. Rent less expenses then gets passed on to the investors. At the moment in Australia, the rent from the REITs is around, say, a 4 to 5% yield. That is the term that gets used. So what that means is that the returns from your shopping centres, your office buildings, your commercial buildings and so on average, after costs, you're getting around, say, 4 to 5%. Now, in 2019 in Australia, we have quite low interest rates. So for some investors, the REITs are an attractive alternative to cash. And indeed, whilst interest rates are low, traditionally growth type investments, so shares and property, generally more money goes into those areas as people seek a higher return or a higher yield. So the theory goes something like, if I'm only going to get, say, 1.5%, 2% in a term deposit or something like that, why don't I invest that money in, say, a REIT, and they're returning, say, around 4%. The answer is not so simple, because they're not intended to be short-term investments. They're not a substitute for cash. They should be part of an overall diversified investment portfolio. Now, one of the things to understand about the income from REITs is the income can be rather predictable. Let me explain why I say that. Think of it like a shopping centre. So the individual tenancies in that shopping centre generally have, say, 5-year leases in place, and those leases typically are indexed to inflation, or there's some indexation to them. So the revenue that the trust receives is very, very predictable, and they know in advance, as long as these people keep paying us rent, we're going to get this amount of money for the next 5 years. So this is different, say, to an investment, say in a company, a typical share investment. You buy a share in a company. There's fluctuations in those returns because you don't know, say, quarter to quarter, month by month, how well that company's going to fare selling whatever it sells. It could be at the mercy of different economic conditions. It could be at the mercy of exchange rates, commodity prices, consumer sentiment, and so on. The cool thing about real estate investment trusts, however, is that there's this contractual obligation for the tenants to pay the rent to the trust. So the income is very, very predictable. On the flip side, there is volatility in these trusts. Volatility to me is how much the unit price or the share price fluctuates in value on a day-to-day, week-to-week basis. And your capital will not remain stable in a REIT. It will fluctuate in value. Which brings me nicely on to the next bit about valuations of REITs. So typically, if it was an unlisted real estate investment trust, so in Australia that would be, say, a managed fund, for instance, if I own property direct or I own shares in property, then what you would have, say you had $1 million in that fund invested in $1 million worth of property. There's this concept of NAV, or net asset value. Real estate investment trusts can trade at a discount to your NAV, to your net asset value. Let me explain that. So you have your $1 million fund. It's got $1 million in it. It's gone out and bought, say, $1 million worth of property on day one. And let's say there were 1 million shares that were issued, because that's very easy maths for us all to do. The share price should be $1 per share, because you've got 1 million shares at $1 gives you $1 million in value, and that's what you've got invested in the properties. But let's say the share market fluctuates in value, and let's say something happens and the share price drops to 90 cents. But the property value is still exactly the same. Let's say the property hasn't gone up or down in value. The property is still worth $1 million. So in that instance, your real estate investment trust, your REIT, is trading at a discount to the net asset value. And it's easy to determine with a REIT. Generally speaking, you can look at, well, what are the assets? They don't fluctuate too much in value, as in the actual properties we're talking about, but the share price will fluctuate. So you could get that instance where your share price is 90 cents, but you look through the assets of the fund and decide, well, actually it's trading at a discount to the net asset value. Net asset value, very importantly, is if every asset of that fund was sold, tax was paid, the proceeds were distributed to the investors, what's that value? So let's just forget about capital gains tax. Let's just say it's $1 million worth of property, and therefore the NAV is $1 million. Now, conversely, you have times where the net asset value is more than the fair value of that fund. So let's say in this instance, the share price, instead of being $1 per share, jumps to say $1.05 or $1.10 per share. Then investors might look at that and say, well, actually, that's quite expensive. It's more expensive than the underlying assets of the fund. You may still choose to invest, but the potential for capital growth will be much more diminished. Whereas when there's a discount to the net asset value, as some REITs are at the moment, you may look at that and say, well, there's almost certainly going to be some capital growth built into this share price, because I'm buying it at a lower value than what the assets of the fund are actually worth. So in 2019, that could be a reason to look at REITs. Another reason why you might look at REITs is this issue of correlation. So when you're putting together a diversified investment portfolio, importantly, you want to have some different types of investments in it that will do well at different times. Now, because REITs in Australia are listed on the stock exchange, they do fluctuate in value. I've already mentioned that in this video. But typically, they perform a little differently to shares. You probably won't get the massive volatility that you could get with some shares. I know some shares that I've looked at recently have had some amazing returns in recent months and some really very, very poor returns. You tend to not get those extremes with real estate investment trusts. Shares generally, and something like bonds or fixed interest, they correlate very nicely. What I mean by that is that if shares drop in value, then typically bonds increase in value. So there's two things in a portfolio together. You'd have a bit going down and a bit going up, and your net result probably isn't too bad. Property sits more on the share side of things, but again, there is some differences in the correlation between property and shares. So having real estate investment trusts in your portfolio could be good from a correlation point of view. It also will be very good from a diversification point of view. If you know me and watch enough of my videos, you will learn that I'm a big fan of diversification. The one factor that I believe very, very strongly in is that your asset allocation 9 times out of 10 will determine your long-term returns. Too conservative and your returns won't be as high as they could be. Too aggressive and your returns over the long term will probably be very good, but you will experience a lot of fluctuation in your capital along the way. The market drops will be some pretty severe drops in your portfolio. But again, with a long-term perspective, that's not such a bad thing. REITs are good because they provide some diversification. I always say you never put all your eggs in the one basket. You don't put everything in, say, Australian shares or overseas shares or all in one share, for instance. You spread it around, your eggs in different baskets. And property is one of those baskets that you can put it in. But the reality is, for a lot of people, we don't have the spare $1 million sitting around to go and invest in one commercial property or a fraction of a shopping centre. But through a REIT, you can get access to a range of diversified properties for essentially the price of whatever the unit price is. So if you had $5,000 or $10,000 or $100,000 out of maybe $1 million portfolio, you could go and put it in REITs. Again, I wouldn't put all your eggs in that basket, and I do stress the importance of a diversified portfolio. In my opinion, anything growth-wise in terms of growth assets, so your shares, your property, infrastructure investments, you should be investing in those with a time frame of at least 4 to 5 years, preferably longer. They will fluctuate in value. And if you invest in a real estate investment trust today and markets drop, say by 10% tomorrow, your capital will probably drop a similar amount. So you want to make sure you don't put money in REITs that you really want in the short term, which is why I said earlier, even though they are performing in terms of yields, the yields are higher than what you would get in a cash account. They're not a substitute for a cash account. They are, again, a long-term investment. So there you have it, some reasons to look at investing in REITs. As I said, part of a diversified portfolio is always important, and again, do stress this as general advice only, not to be taken as personal financial advice. That's why you would go and see a financial planner or somebody that can give you personalised advice in this area. Hope you enjoyed the video. Leave a comment below and let me know what you think. I'd love a thumbs up on the video as well, and if you haven't already, please subscribe to the channel. I think you'll enjoy it. Thank you so much for watching.